Hello, welcome to this lecture on payment services and the regulatory landscape for them in Asia Pacific. I'm Dan Ewan, the General Manager and Managing Consultant for EMEA of KorumLegal. Most people are familiar with the term financial services. Less is understood about payments. Not many people know or understand what it means. Payments has traditionally been neglected or underserviced as an area of the law and as a subset of general banking and financial services. This is out of step with how payments have quickly evolved to become a hotspot of commercial and fintech activity in recent years. In addition to the more traditional players such as the high street banks and credit card companies like MasterCard and Visa, and global remittance players like Western Union, MoneyGram, PayPal, new players are constantly emerging. These include Monzo, Airwallex, TransferWise, WorldRemit, TransferGo, Aussie Forex, Paybase, Azimo, the list goes on. The level of innovation in this space is dizzying, and many hundreds of millions of dollars are being poured into these companies by astute investors. So, what do we mean by payment services? At its simplest, a payment service is any service provided by a financial institution to allow a person or a business to pay another person or business for a product or service. A payment service provider offers merchants online services for accepting electronic payments by a variety of payment methods, which includes credit cards, bank-based payments such as direct debit, bank transfers, and real-time bank transfers based on online banking. Typically, they use software as a service model to form a single payment gateway for their clients to multiple payment methods. Payments also cover money transfer and remittances, cross-border payments, including consumer to consumer, business to business, consumer to business, and business to consumer, and credit cards, debit cards, stored value cards, and so on. Now that you understand better what is a payment service, let's now touch on the regulatory frameworks for payment services in the Asia-Pacific region. Until about 8 years ago, the regulatory landscape for payments in APAC was relatively light touch. Regulations were playing catch-up with the new technologies, which allow for an abundance of new products and services to emerge, including fintechs. The existing regulatory frameworks in many countries were simply not equipped to address the many challenges and risks posed by these new technologies, products, and services. Most of these laws were enacted at a time when these technologies did not exist or weren't contemplated. For example, in Singapore, the relevant law, the Money Changing and Remittance Business Act, dates from 1979 and remained largely intact with few substantive updates or modifications for 40 years. The new law to replace it, the Payment Services Act 2019, was only gazetted in February 2019. It's expected to come into effect sometime at the end of this year or early 2020. In Australia, remittance services and remittance service providers were not regulated until 2011, when the Anti-Money Laundering and Counter-Terrorism Financing Act 2006 was substantially amended to provide for this. Lawmakers could not have imagined the full potential of technology to fundamentally transform how payment services would be provided to consumers and businesses in the digital age. Few could have predicted that you could send and receive money via your online messaging app, or with a few simple clicks on your smartphone you can open a bank account or apply for a debit card. But lawmakers and regulators entrusted to enforce them have been catching up. They've been busy enacting new laws or amending existing ones to regulate these new activities and products. Since 2010, we've seen new payments or funds transfer laws being enacted in Japan, Singapore, Malaysia, Thailand, Indonesia, Australia, New Zealand, and the Philippines. While each national law is different, they all essentially share some common themes. They all focus on AML/CTF compliance, good governance, effective technology risk management, the need for robust internal controls and frameworks, and consumer protection. For example, those against risks of fraud and unauthorized use or mishandling of customer funds. I will now speak a little more in depth about one of these new laws, the Payment Services Act in Singapore. The stated objectives of the Monetary Authority of Singapore, the Central Bank of Singapore, were to streamline payment services under a single legislation, enhance the scope of regulated activities to address current and future developments in payment services, calibrate regulations according to the risks the activities pose by adopting a modular regulatory regime. The Payment Services Act adopts an activity-based approach to the licensing and regulation of payment services and classifies them under 7 key activities. You can see these on the screen right now. More than one activity can be engaged in, but only one license will be needed to cover all activities. Retail payment activities will be grouped into three main license classes: money changing license, standard payment institution license, and major payment institution license. The regulation of licensees is calibrated according to their activities based on the risks and these regulatory concerns: money laundering and terrorism financing, consumer user protection, interoperability, and technology risk management. No doubt, the emergence of new technologies has created tremendous opportunities for new players to enter this exciting and dynamic market. The financial services sector was ripe for disruption. Consumers have greater choice when it comes to the types and availability of financial services products. This has also enhanced financial inclusion and access for everyone. But with new opportunities, there are additional legal and compliance obligations and risks. Regulatory and compliance burdens for players seeking to operate in this space can be quite onerous and shouldn't be underestimated. Scrutiny from regulators in the region has increased significantly. Regulators expect payment service providers to have in place robust compliance, risk management, and governance frameworks to ensure they can meet their legal and regulatory obligations and to protect consumer rights and interests. There needs to be a thoughtful approach to compliance and risk management, which will help the company to establish disciplined management of financial crimes, operational risk, and consumer protection. Regulators also expect providers to take active steps to enforce the compliance and risk management framework and to monitor compliance against the requirements. Navigating through these complex and onerous legal and regulatory regimes can be daunting. The costs of compliance can be high. In some cases, this may affect the commercial viability of their business. So having in place a well-thought-out strategy and an effective and robust compliance and risk management framework will help payment service providers to take full advantage of the opportunities that the new technologies offer. It can also cushion the business from the downside risks of running a non-compliant business. The legal, financial, and reputational risks for the company, for its senior management team, are far too great to simply ignore or downplay. But where the company has a good understanding of the regulatory requirements and a culture of compliance is promoted and embraced by senior management, the company is positioned well for success in this burgeoning area.